All right, good morning, everybody. Mike Courtney here, Mass Mutual, Eastern Pennsylvania, and I am joined by my good friend and counterpart, Steve Parisi, President and CEO of IBC Global. Steve, how's it going today?
Fantastic, my friend. Got my double shot. I am good to go for the day.
Coming along as always.
Exactly.
So we're talking today about short pay, whole life scenarios, and in particular, lump sum funding. So, if you just pick up the phone and call somebody at Mass Mutual and say, I've got $1 million, I want to dump it into a policy for, whatever reason, we can talk about reasons a little later on. But, they're probably going to steer you pretty quickly in a different direction with regards to case design. So let's talk about maybe why that is and what you can do to help.
Yeah, definitely. Lump sum funding, which just means someone has a lump sum of cash, $1 million, like your example. They want to throw it into a policy. They're specifically interested in cash value, and they want to have access to the maximum amount of cash value from day one, but also they don't want to sacrifice long-term performance. So to summarize, I'm interested in the cash value benefits of a whole life insurance product, but I don't want to make payments for my whole life. I just want to use that lump sum and be done with it. So when it comes to a lump sum, I love them because you can fund a policy for a short period of time. A lot of corporations are attracted to that because they don't want to be on the hook for payments for a long time. But to your point, as far as if you're a consumer and you're interested in funding a policy with a lump sum, you may be steered toward in a different direction. My question would be, why is someone doing that? And there could be a number of reasons as to why they're trained. But it can also be.
Well, I'll tell you where the Mass Mutual training goes. It's been ingrained in us to use SPIAs to fund those kind of transactions. So the cookie cutter case is, Grandpa has $100,000 and wants to fund life insurance policies for a couple of grandchildren, but doesn't want to be on the hook for 10 or 15 or 20 years of payments. Doesn't even know if he's going to be, still around at the end of that payment cycle, and says, I want to dump money into a vehicle that's going to make those payments. So our natural training in that scenario is purchase a period certain SPIA and link the SPIA to the life insurance policies, and the premiums automatically come out of the SPIA every year and are deposited to the life insurance. Works fantastic. SPIA rates right now are through the roof compared to where they've been historically. It's a really nice emotional sale when it works out like that. The problem is, in that scenario, if you're depositing $100,000 into a SPIA, you really are losing access to a large portion of that cash as the premiums are systematically deposited into the life insurance policy over a certain amount of years.
Yeah, got it. So thanks for that overview. So a SPIA, in case anyone listening doesn't know what that is, single premium immediate annuity. Some insurance companies use what's called a premium deposit account, where it's exactly what you described. Grandpa has $100,000, gives it to the insurance company, and then the insurance company says, okay, thanks for the $100,000. Then $10,000 per year is moved into a life insurance policy for 10 years, might come out to $11,000 per year with the interest that's generated. But what you're doing is saying, here's the future premiums. The company says, thank you. We're going to apply interest to this money. And then every year we'll feed your life insurance policy. So now it's fed for the next 10 years. You don't have to think about it. And then as the cash value builds up in that policy, you've got access to it. But any money in the SPIA, the annuity, you do not have access to. Summarizing?
Mm-hmm. Absolutely.
Yeah. So those cases, so that is very, very common. And it can work. Like the case that
those cases are going to work well where you're not so focused on cash value.
Right.
Long-term play. Those are great vehicles.
Correct. And an example of a grandfather or grandparent doing that for their grandchild or something like that is the perfect case study. Like that's often where someone would be attracted to it. I'll let you know this. 0.1% of people we speak with are attracted to those strategies. Very, very small. Because if you've got a real estate investor or a business owner with a lump sum of money, they do not want to tie that up for any period of time, whether it's 10 years, even a year. If an opportunity comes, they want control of their money. That's the big, big thing. So what we'll look at instead is to say, okay, let's keep your money liquid. I've got it over here in a money market or wherever it is. And then what we can do is just lump sum fund the policy. The question is this. So the question we always get is, okay, I've got $1,000,000. Can I just write you a check for $1,000,000, throw it into the policy and be done with it? Never make another payment.
That doesn't feel like that works mechanically with the policy.
Correct. Yeah. So my answer is technically you can do that. However, you'll look at it and you won't want to do it.
Right.
It looks horrible from a cash value standpoint because from the agent's perspective, you got to make sure the policy doesn't mech. You need a very, very high term rider, a very large term rider. Your base premium is still going to be due for several years. And if the client's expectation is, I don't want to make any payments beginning the second year, like here's the check and I want to be done with it. Well, that premium is still going to be due years 2, 3, 4, 5, 6, and 7. So you don't have to pay it. However, it's still due. So the policy is going to pay for it on its own. And without getting into too much detail there, the expenses with a one-time lump sum policy, the expenses in the policy are going to exceed the earnings. And a lot of times we'll see our value go down. That's why we wouldn't want to do it. Any questions?
Long term, those values probably bounce back.
Yes.
And turn around. But I feel like in that kind of situation, if someone is that keen on early on cash value, they're probably also using that cash value. This isn't a long-term play. It's a day-to-day operational kind of play as far as mentality. So you've got money that you're using or cash value that you're using, and then also the base premium every year is getting deducted from that cash value in the form of a loan, in a nutshell. So you've really got a significant amount of drag on that cash value.
That's exactly
from the get-go, right?
Yeah, that's exactly it right there. And there are times what I prefer to do is show that from a visual standpoint, because you get this a lot with individuals in their 50s, 60s, and 70s who have the means to do that. They've got a lot of cash saved up, and they see a dividend interest rate with a whole life insurance company and say, wait a minute, like if I just write a check for $1,000,000, say it's with Mass Mutual, who has a 6% dividend interest rate, shouldn't that start just to earn 6% right away? Like that's the mentality.
Sure.
It doesn't work like that.
That's logic. But
correct.
Yeah, that would make sense. Yeah.
Correct. So it doesn't work like that. So explaining that effectively, using visuals where needed, like that's the important part to really help the consumer understand exactly what they're getting. And if they're technical, explain the additional pieces to say, here's the premium, here's the term insurance rider cost, here's everything that comes with it, and this is why it's not working. Okay, with that said, here's what people will typically do as an alternative. You can take your same $1 million and look what happens if you fund the policy over 2 years or 4 years.
You see pretty drastic improvements, even going from 1 million 1 year to 500,000 over 2 years.
Oh yeah, it's huge when you really look at the overall difference. Yeah, we can pull up an example if you'd like.
Please.
All right, let's have some fun, my friend. And this is good because this is based on a case study we ran into yesterday, actually. And here's what I'll do, is to kind of make this like a, call it a PowerPoint presentation within Excel. So individual, 66 years old, right? Mid-60s, says, I have $1 million. I want to fund this whole life insurance policy. I know as soon as I just see the email come through, I'm like, okay, here's what he wants to see. It's not going to make sense. It will not look attractive. But I am a firm believer in showing people what they want to see. If I just brush that off, he's going to say, this person doesn't listen to me, and go get it from someone else. So
this is a heavily blended term rider, paid up additions rider, base premium, and then it looks like you went reduced paid up after year 7.
Correct.
Mm-hmm. Okay.
Correct. And this is based on the present dividend interest rate, not the guarantees, which you've got to look at here too. But what we've got here is a $1 million deposit. There's your first year cash value. So close to 90%.
Right.
This is a non-MEC, which is why that death benefit is so high initially. Year 2, you're out of pocket in the annual funding column is 0. You don't pay anything, not the premium or anything. And your cash value does creep up in year 2. But then what happens yeah, based on the guarantees, it does not. So that's what we've also got to look at. But year 3, what happens? Starts to go down. And it continues to go down. You lose a lot of money when we look at it until year 8. And the reason why is what you had mentioned, that reduced paid up option, which eliminates the premium at that point in time. We'll look at a visual with more details on that too. And we'll go through the illustration too so people can actually see this. That's what we'll do in working with individuals. But that's your one pay. And this often creates the reaction of, ugh, why would anyone do this? Well,
yeah, I mean, you're going backwards.
Yeah,
over $100,000.
Correct.
Excuse me.
The answer to the question is no one would do it. It doesn't make any sense. And now if you kept on paying premiums, it's a different story. But this is for the individual that has $1 million and doesn't want to keep paying premiums. So 66, that's his age. Same product here, the same company, one tweak, splitting that funding up over 2 years.
Well, then you can do what? Much less death benefit.
Much less death benefit. You'll notice it's almost exactly half.
Yeah.
The reason why that is because this person expressed, I don't care about the death benefit, not initially. That 10.3, based on his age, gives him a $1 million MEC limit. Cut the death benefit in half. What happens to the MEC limit? Also cut in half.
Right.
Solving for the minimum amount of life insurance to be able to feed the policy with the desired amount. So when we compare the two, it looks way better. Look at it by age.
Yeah, and from I understand the mentality of I want to get all this money into the policy because I want to put it all to work. Like I get it.
Mm-hmm.
I brought something up to you before we got on the call where I always felt like in the past, if you have specific ideas for how you're going to utilize these dollars, why not just take a couple $100,000 and spend it on your business expenses or whatever this opportunity is. But then that money's gone. It's not to work for you. It's not working for you in the policy. So I get it. So from a availability of funds perspective, in this second scenario, it's really only year 1 that you've got limited funds available.
Correct. Correct. And that's
everything after that is more.
Yeah. And think about it too. I mean, if the person from a timing standpoint can backdate the policy, you can get those 2 payments in over 6 months.
Right.
So looks more attractive. Now, this is for someone a little bit older, which at his age, I would actually recommend spreading it out over 4 or 5 payments if the goal is to maximize cash value. And I'm looking at both the current dividend rate and also the guaranteed values. So
go back and talk about that backdating. I think that's important because
you
don't see that a lot. And we've worked on some cases that have looked like that where, timing wise, you can shrink that time.
Yeah. So the backdating, what that is if I'm starting a policy in June, because we're in June right now, and I want to backdate a policy 6 months, what that will do is I physically start my policy. I send my first payment in June, assuming I'm approved then. But my policy date is 6 months earlier, January or December. So what happens now is I make the first payment in June, but now instead of waiting a full 12 months until my next premium is due, in this case, the $500K, well, now it comes due in December, 6 months from today, so I can get the money in earlier. The thing to
we had problems with cases like that because they would only backdate save age, right?
Correct, and that is still the case. So for
with Guardian.
Yeah, same thing. Yeah.
Okay.
Same thing. So
it's just got to line up with aging and
correct. But it is possible there. And we've got content that goes through backdating.
Right. Got it.
But here we go.
4 pay.
5 pay, actually.
5 pay.
Yeah, I had the wrong number up there. But now what we've got, spreading it out over 5 years. And 4 years looks almost the same here, but the guarantees are stronger with the 5 pay, which is why I did this. But same $1 million in, break even point now between years 4 and 5, just about there year 4. Keep in mind, this is someone starting 66 years old. So older individual, second best class, regular preferred is what this was run with. But what we've got now, substantially more cash value across the board. And this is all the same product, same company, same health rating, just a different way of getting the money in. And the
the 5 pay is just clearly better.
Yeah, the sweet spot
From
for
all
him.
perspectives, except for first, 4 years of available cash value.
Early capital. Yeah, that's the big thing. So this gives a nice snapshot, or the illustrations provide the details. If the question comes up why, and someone wants to really understand it, what we'll look at is the same thing here. So a lot more columns, but this is the exact same thing, just with additional details. And this is for someone that says, okay, show me the information here. What's going on? Example to the left. You've got your base premium. You've also got your term rider cost. All right, so my sheets are a little condensed here. There we go, term rider cost. So what's happening here, year 1, you covered the premium, you covered the term insurance with your total $1 million deposit. Everything above those two went to PUAs. Year 2, you still have a premium and term cost due.
Right.
Term cost is going up. This is a 1-year term rider.
And you can't just let that term lapse right away, because then you'll mech.
You got it. Death benefit has to stay up for the first 7 years.
Right.
So what happens with the next 2 examples, we're covered. 1, we reduce the premium and term rider cost, but 2, we're covering it for 2 years, and then in this example for 5 years. So we're getting the plane off the runway, and then by the time that we don't want to fund the policy anymore, the compounding in the policy easily satisfies that premium and term cost. Like, it's a non-issue.
Well, and the premium and term cost is so much less.
Correct. Yeah, correct. And there is always a balance. We mentioned earlier, age is important. But a question comes up with this, like, all right, well, if I spread it out over 7 years, would that be even more efficient? And the answer would be no, when you look at the numbers side by side. The reason why is, yes, you have 2 years of drag here. However, you're also getting the money in faster, which does allow it to compound faster. So it's really finding that sweet spot to see when will the compounding in the policy exceed those expenses.
The compounding outperforms the drag.
You got it. That's what we're looking for. Yeah.
Okay.
Yeah. So again, it does depend.
This is a good side. This level of detail is great. The side by side before, I think, paints a really easy picture of and would help you make a decision. It'd be hard to look at this and not go the 5 pay route, but depends on specific scenarios, I guess.
It does. I mean, occasionally you might see someone go the 4 pay because they're very, very similar, and they might want to just get the money in faster. Depends. You look at other things too. So this one has a 4 pay in it, but this is based on the guarantees. And you'll see that 5 pay, even based on the guarantees, you've got that premium and term cost still due. But in an absolute worst case scenario, I'm still going up in value. Whereas all of the other ones are during those 7 years.
Well, listen, if anybody out there wants to dig into these designs in greater detail, as you can tell from Steve's spreadsheets, they really go deep with these cases. But that's why you guys are, best in class to talk to about case design and different solutions with regards to whole life and cash accumulation. So really appreciate it, Steve. Thanks a lot for your help today.
Yeah, the feeling's mutual. Thank you so much. Appreciate your time. We'll
give us a call anytime you want to chat. Mike Courtney, Steve Parisi. Everybody have a great week.
Later, Mike.